Hello everyone, welcome back to Crack Grade B. So today we are going to discuss few of the schemes which have been started by Ministry of Finance, right? Before we start with our first scheme, I would like you to know that whatever content we are teaching over here, please understand it and please try to remember each and every point as much as you can, because the questions which can be asked out of such schemes can be in depth, and you should be having information in depth as well. All the provisions which are written in this particular lecture or in this particular PDF series are important to you, so just please pay attention to it. Now let's start with the first scheme that we have, called as National Pension Scheme. So this scheme was started back in 2004, and first of all it was started for government employees, and then it was extended to everyone. So in this particular series we'd like to know that who is the regulator, what are the provisions of the scheme, what is the eligibility, right? How can you withdraw the amount? What are the tax benefits which are available to you? So all these things we are going to discuss one by one. Wherever I will feel like this provision is getting tougher, I would like to explain it in simple terms. Hence, it is advisable that you pay all of your attention in this lecture. So let's start. Wherever the important point will come, I would like to emphasize on it, and you also remember that you have to pay attention to this particular point more. So National Pension Scheme was for central government employees who are joining services except for armed forces on or after January 2004. But later on it got adopted by all the state governments for its employees. Then it was extended to all Indian citizens, whether resident, non-resident or overseas. Now who are these overseas citizens of India? They get a card called as Overseas Citizens of India. They do not get citizenship, but what they get is residency rights. So these are the persons of Indian origin, means they have the connection with India, but they are not the citizens of India. What they get out of this OCI card is Overseas Citizen of India card holder. That means they can reside in India, correct? And they can do other stuff, but they cannot vote in India. So that is OCI card holders for you. Now see, one by one each of the provision which we are going to discuss. So NPS was extended to all the citizens, very important, all citizens along with the OCI and non-residents on voluntary basis from May 2009. Now citizens can be resident as well as non-resident. Citizens can be of two types. Resident means who is present in India for a minimum number of days. Like more than 180 days if you have been present in India. There are other conditions for it as well, but I am just making it simple for you that if you are present in India for more than 182 days, then you are a citizen as well as resident in India. But suppose, for example, Priyanka Chopra. Priyanka Chopra is a citizen of India because she is having Indian passport, right? But she is a non-resident because she has not been spending more than 182 days in India lately, correct? Next thing, who is eligible? Resident, non-resident and OCI are now eligible to join up to the age of 70 years. Remember this particular thing. Now let's see the age limit. Whosoever wants to join National Pension Scheme should be between 18 to 70 years of age, should comply with the Know Your Customer norms, KYC norms. See, in this, if you are doing a business, then your business details are taken. Normal informations like your Aadhaar card, driving license and other kinds of documents are taken in order to verify your identity. So you should be fulfilling Know Your Customers norms. Any Indian citizen and overseas citizen of India in the age group of 65 to 70 years can also join NPS and continue up to the age of 75 years. Normally what happens is that if you want to have pension in your old age, then you should start early, right? Because here the limit has been given from 18 years. If you have attained the age of 18 years, then you are eligible for depositing money into NPS, National Pension Scheme. But sometimes it may so happen that people who are now in their old age may not be having information about this scheme at their time, and obviously this scheme was started in 2004 and they were not aware about such kinds of schemes previously. So government says that we care for you, and we have come out with the provision that if you are in the age group of 65 to 70 years also, then also you can join and you can remain up to the age of 75 years. Now what are the benefits? Let's see. First thing, it is world's lowest cost pension scheme. Administrative charges as well as fund management fees are also very low. Apart from this, you get the tax benefits as well. So when I was telling you in the direct taxes that there is section 80C, 80CCC, correct? 80CCD, 80CCD that we call it as. Here you get the benefit when you deposit the amount into pension scheme of the government, right? So what is the amount of deduction? 10% of salary deduction is given to the employee, correct? But there is a limit. You can get deduction up to 1,50,000 only. If you are an employee, then if you have already consumed the limit of 1,50,000, suppose 10% of salary is coming at 1,80,000, then you can claim 1,50,000 above, and there is another section called 80CCD 1B. There you can claim another 50,000 on account of NPS. Right? So tax benefits will be available. Subscriber is also allowed to deduction in addition to the deduction allowed under section 80CCD 1. Under section 80CCD 1, you can claim up to 1,50,000. That is 10% of your salary. But if 1,50,000 is not sufficient for you, then government has already given one more section 80CCD 1B where you can claim additional deduction of 50,000. These deductions are for employees. Next is, who regulates NPS? NPS is regulated by PFRDA. So you have to remember this particular thing. With transparent investment norms and regular monitoring and performance review of fund managers by NPS Trust. So this is the agency, and NPS Trust also regulates it. Now there are two types of account. Two types of accounts are relevant with the condition whether you can withdraw the amount before or not. On this basis, there are two types of account. One type of account provides you restriction, means you cannot withdraw the amount. And the second type of account does not considers any such kind of restriction. So there the terms and conditions are also different for both of them. The first type of account which do not allow you to withdraw the amount has got tax benefits, and the other type of account which allows you to withdraw the amount does not have any kind of tax benefits. This is similar like your savings account and fixed deposit. In fixed deposit, you cannot withdraw the amount, but you get a good rate of return. Whereas in saving account, you can withdraw n number of times, but the rate of return is not that good. Correct? So now just understand this two types of account. There is tier 1 account, retirement account, and a restricted withdrawal account. So the aim here is that when you will retire, you will get pension out of NPS. Therefore, this account restricts the withdrawal that you can make out of this particular account. This is available from 1st May 2009. Minimum amount of contribution should be 500. Minimum amount per contribution rupees 500. Per year 1000. Minimum number of contribution is 1 per year. So you can do the contribution once per year, or such kind of frequency you can adopt. Next is tier 2 account. Here applicant will be free to withdraw his or her savings from this account whenever he or she wishes. So the tier 2 type of account, see, What are the features of it? It is not a retirement account and applicant cannot claim any tax benefit for the contributions to this account. The facility of Tier 2 account is available from December 1, 2009 to all citizens. Minimum contribution when you will open is 1000 and minimum amount per contribution is 250. Means every time you will deposit something in National Pension Scheme, the contribution cannot be less than 250 rupees. At the time of opening, you have to give 1000 rupees. This is just like a registration. When you are doing the registration, provide 1000 rupees, and after the registration, when you have to provide monthly or let's say yearly amount, then the contribution cannot be less than 250 rupees. So there is no minimum contribution requirement for the financial year, and also there is no cap on the maximum contribution. So for a financial year, no cap, correct? But it says that every time you will deposit any kind of fund into National Pension Scheme, that amount cannot be less than 250 rupees. Here yearly cap as well as maximum cap is not there. Now let's talk about how you can withdraw the amount from this National Pension Scheme. Partial withdrawal, premature withdrawal and normal withdrawal. Partial withdrawal means suppose if you have 100 rupees into your fund, then you want to withdraw 50 rupees. This is partial withdrawal. Premature withdrawal means you have 100 rupees and you want to withdraw as much as possible before time, before the time has been complete. And what is the normal withdrawal? So this means when time has been completed. Right? Now see, partial withdrawal. So after completion of 3 years, subscriber can withdraw 25% of her own contribution for specific reasons like illness, disability, education, marriage of children, purchasing property, starting a new venture, etc. A subscriber can partially withdraw up to a maximum of 3 times during the entire tenure. Means whenever you are withdrawing, you how much you can withdraw? 25%. And how many times you can withdraw? For maximum 3 times. Means suppose in during the tenure you have withdrawn once for your illness, once for some marriage, once for starting a new venture. So like that. Next is you want to withdraw before time. So when you can do premature withdrawal, once you have completed 10 years or before completion of 3 years, if subscriber has joined after 60 years of age. I have told you know that in your old age also you can join National Pension Scheme, because this has been provided by the government and government cares for all. So government gives you the what you can say the option that you can join National Pension Scheme after your age also. That means if even if you have attained the age of 60 years, you can join it. So there are two conditions for a person who has joined in the normal age, that is before 60 years. For him, once he has completed 10 years, and for the person who is a senior citizen, before completion of 3 years. Subscriber can withdraw maximum 20% of the corpus as lump sum. Lump sum means the maximum. Suppose if in your funds you are having 20 lakh rupees, then in that scenario 20% of it, that means 4 lakh rupees will be given to you in your hand. That is called as lump sum, and the remaining 80% will be utilized for giving the annuity to you, that is a monthly payment to you. Next, if the accumulated corpus is less than 2.5 lakhs, then the entire corpus will be paid to you, means the entire fund will be paid to you. Now what about normal withdrawal? So if you have completed 60 years of age, and obviously you joined the scheme before you were 60. For other people, for a subscriber who has joined this particular scheme after he attained the age of 60 years, if he has completed 3 years in this particular scheme, then he can withdraw maximum 60% of the corpus as lump sum. Like if you have 20 lakh rupees in your national pension fund on your account, then you can withdraw 60% of it. That means 12 lakhs will be given to you in one go, and the remaining 8 lakhs will be used for providing you the pension. If accumulated corpus is less than 5 lakhs, then in this scenario, entire fund will be paid to you. In case of premature withdrawal, what was the limit? 2.5 lakhs. If your fund is less than 2.5 lakhs, then the entire fund will be paid to you. Next is, subscriber also has the option to continue in NPS till the age of 75 years or exit any time after such continuance before 75 years. While exiting, he can defer receiving the lump sum till the age of 75 years or withdraw the same in installments till 75 years. See, once you complete the age of 60 years, you are eligible to receive 60% of the funds in lump sum. Now you can defer it. How you can defer it? You can say that I do not want to withdraw right now. I'll take it later on. So you can take it later on as well. If you want that this 60% should be given to you in installment, then that can also happen. Annuity purchase also you can defer for a maximum period of 3 years. If you die, then the option will be available to the nominee to receive 100% of NPS pension wealth in lump sum. That means if you die, then who will receive the pension? So your nominee will receive 100% of the total funds, whatever is there. Next is for subscribers who are in the age of 65 to 70. Subscribers who are joining NPS after the age of 65 years will have the option of normal exit once they have completed 3 years. So for a subscriber who has joined NPS before the age of 60, for him, when normal withdrawal occurs, when he attains the age of 60 years, right? But for one person who has joined the NPS after he has attained the age of 65 years, for him, the period is for 3 years in NPS. Subscriber will be required to utilize at least 40% of the corpus for purchase of annuity. Before 3 years, if he wants to do that, then he should utilize at least 80% of the corpus for annuity. That means the pension which will be paid to him annually, and 20% can be given to him in lump sum, that we have already read. However, if corpus is less than 2.5 lakhs, then he may withdraw the entire amount. Entire corpus will be paid if the subscriber dies. Next, with effect from 2019, the lump sum withdrawal up to 60% wealth at the time of superannuation is tax exempt. Superannuation means when you have attained the age of 60 years, then 60% of the fund is given to you in lump sum. Lump sum means in a single amount. It is given to you. So this particular thing is tax exempt. You will not be charged any tax on it. Partial withdrawal up to 25% is tax free. If you withdraw partially up to 25%, then that is particular thing is tax free. Next, additional deduction 50,000 is available under section 80 CCDB if you are an employee and you have purchased national pension plan, then whatever contribution you are doing, you will get up to 1,50,000 deduction under section 80 CCD1. But if the amount contributed by you towards national pension scheme is more than 1,50,000 and you were not able to claim the whole under section 80 CCD1, then the government has provided you additional deduction of 50,000 under section 80 CCDB 1B. This we have already done. Now let's see Atal Pension Yojana. First thing first, what you have to remember, when the scheme has been started. So this has been started in 2015. Basically, this particular scheme is for the benefit of the people who are working in unorganized sector. These people are not covered by any other social security scheme. Correct? So to provide a defined pension depending on contribution and its period to all the citizens in the unorganized sector. All Indians who are in the age group of 18 to 40 can join with focus on unorganized sector worker. So what was the limit in National Pension Scheme? 18 years to 70 years. And what is the limit over here? 18 years to 40 years. Correct? Age of exit as well as start of pension would be 60 years. Thus, the minimum period for which you have to be contributing is 20 years. Suppose if a person joins when he is of 40 years of age, then he will be start receiving the pension after he has attained the age of 60 years. That means he has to contribute towards this pension yojana for a minimum period of 20 years. Obviously, if someone joins at the age of 35, then he'll be contributing for 25 years. But in any situation, you cannot join the scheme beyond the years of 40, age of 40. Now, central government will also co-contribute 50% of total contribution or 1000 rupees per annum, whichever is lower. 50% of total contribution means the amount which is being contributed by the subscriber. So what is happening in all these pension yojana is, first you have to contribute like every monthly, every quarterly, like you have to make the payment, and then once you attain the age of more than 60 years, like once you attain the age of 60 years, then you will be eligible to receive pension. Correct? Now you are contributing, government will also match the contribution. Match the contribution how much? Either 50% of your total contribution or 1000 rupees, whichever is less. Now remember this particular thing, 1000 rupees is not per month, this is per annum. Because obviously there are so many people in India, government cannot contribute too much. Even 1000 rupees per annum for this huge population is too much. Correct? So whatever is lower for a period of 5 years. Now what was this period? 2015-16 to 2019-20. Whosoever has joined between this particular time. Plus they should not be members of any other statutory scheme, plus who should not be income tax payers. If you are an income tax payer, then obviously you are quite well off and you do not need the social security which is being provided by this particular scheme. So subscribers will receive minimum pension of 1000, 2000, 3000, 4000 per month. Now why this variation? So this will depend on the contribution that you have made. If you have made less contribution, then you will receive less pension. If you have made more contribution, then you will receive more pension. So these are the slabs. When you will start receiving the pension, once you will attain the age of 60 years until death. Now amount of the pension depends on the contribution that you will be making per month. Which entity regulates this? PFRDA. Now see, penalty for default. If 1 rupees per month for contribution up to 100 rupees, 2 rupees per month if your contribution is between 101 to 500, 5 rupees per month if your contribution is between 501 to 1000 rupees per month. So depending on your contribution, what amount you have to give to the government per month, if you delay in depositing these particular amounts, then this is the penalty which will be levied over you, right? So the penalty amount is also very less because the people for which this particular scheme has been made, they are belonging to the unorganized sector, and obviously they do not have much leeway along with them. Now, there was an earlier scheme called as Swavlamban scheme. So whosoever was the subscribers to this particular scheme has been merged with the Atal Pension Yojana. We'll read about this particular scheme as well. The subscribers who were there in this particular scheme has been divided into two categories. The people who are having the age up to 50 years has been given a separate category, and the people who were in the age group of 51 to 59 years may have been made another category. Now let's see what are the features. So tax benefits available under Atal Pension Yojana are same as National Pension Scheme as per the notification. So that ATCCD1, ATCCD1B that we discussed remains the same. After the subscriber's demise, the spouse shall be entitled to receive the same pension amount as that of the subscriber. Now remember this particular thing, this is very important. Spouse will receive the same pension amount. Sometimes when we do not have the information and we try to make a guess out of the scheme, what we tend to do is we understand that okay, if the subscriber was getting a pension of 5,000 rupees per month, then his or her spouse must be getting just 2,500, 50% of it, right? We try to make a guess, but please understand that in this particular scheme, the amount of pension will remain the same for the spouse as well. After the demise of both the subscriber and the spouse, nominee shall be entitled to receive the pension wealth as accumulated till the age of 60 for the subscriber. Let's talk about the application. So Atal Pension Yojana applications may be submitted to any of the following enrollment agencies. If you want to be an subscriber to Atal Pension Yojana, if you want to start with Atal Pension Yojana, then where you can submit your enrollment, all banks including nationalized private banking companies, regional rural banks, cooperative banks, through service providers, aggregators, or the business correspondents, right? So the scheme is very wide and you can enroll through all these options that are available to you. Exit and withdrawal: if you want to withdraw before the age of 60, then you will be refunded the contribution only which has been made by you with the net interest. Government's contribution will not be returned to such subscriber. I repeat, if you want to withdraw before the age of 60 years, then government says we are not a fool. We are providing you this particular scheme so that you may be having a pension in your old age. But if you want to withdraw beforehand, then whatever amount you have deposited along with the interest we will pay to you, but government's contribution and the interest will not be paid to you, right? Now let's talk about the Swavlamban scheme. Under this scheme, Government of India will contribute 1,000 per year to each national pension scheme which has been opened for this particular time period and for 5 years. Who were the eligible citizens? 18 to 60. Eligible individuals in the unorganized sector can open an account through their aggregator and get an individual subscriber account. This account is regulated again by PFRDA. There were no minimum amount required per annum or per contribution. Subscriber was free to choose whatever amount he or she wanted to invest. The existing subscribers would be automatically migrated to Atal Pension Yojana unless they opt out. Now there is an update. Total 4 crores account have been opened till March 2022. In this, more than 99 lakhs account were opened during financial year of 21-22. right? Scheme has seen this tremendous success because all categories of banks have participated. 71% of enrollments have been done by public sector banks, 19% by regional rural banks, and 6% by private sector banks. So when everyone contributes, your scheme automatically becomes a hit. Next is Pradhan Mantri Suraksha Bima Yojana. Now, please try to understand the thing that Pradhan Mantri Suraksha Bima Yojana, and there is one more another scheme called as Pradhan Mantri Jeevan Jyoti Bima Yojana. Just wait for a second. Yeah. So Pradhan Mantri Suraksha Bima Yojana and there is Pradhan Mantri Jeevan Jyoti Bima Yojana. So there are few differences between both of these I would like to tell you. First difference is with relation to contribution. So in your Suraksha Bima Yojana, the contribution is for 12 rupees, right? In Jeevan Jyoti Bima Yojana, this extends to 330 rupees, right? Per your annually contribution is that much. Apart from it, in Suraksha Bima Yojana, your partial what you can say disability is also covered, but whereas in Jeevan Jyoti Bima such kind of partial thing is not available. So such kind of few basic differences are there in both of these. I would have told you this later on as well, but otherwise it would have contributed a confusion in your mind. Therefore just understand that what provisions I am telling you over here, and then we have to compare this with Pradhan Mantri Jeevan Jyoti Bima Yojana. Let's start. So, Pradhan Mantri Swasthya Bima Yojana, this was launched in 2015. All savings bank account holders in the age group of 18 to 70 years in the banks are entitled to join. Aadhaar would be the primary KYC, correct? The cover shall be for 1 year period, means every year premium will be charged from you and you will be remaining covering for 1 year period. This period will start from 1st June to 31st May, right? This is renewable year to year. This means every year you have to pay the premium. What all is covered over here? See very carefully. First, the death is covered. If the subscriber dies during this cover period, then nominee will get 2 lakh rupees. If partial disability occurs like total and irrevocable loss of both eyes or loss of both hands or feet, then sum insured is 2 lakh. If total and irrevocable loss of sight of 1 ear, then you will get the sum insured at 1 lakh rupees. So what I would like to tell you over here is what is covered. Death is also covered. Apart from it, if your partial disability occurs, then that is also covered. This and one more thing, this death is not natural. This is accident related death. If you die in accident, then you will receive this 2 lakh rupees as sum insured. Suppose if you die a natural death, then you will not be eligible for this sum insured, correct? Now what is the regulation? Who does the regulation? So public sector general insurance schemes do the regulations over here. What is the premium amount that is payable? 12 per annum per member. The premium will be deducted from the account holder's saving bank account through auto debit facility on or before 1st June. Because from 1st June this scheme starts. From 1st June to 31st May. So if you are a saving account holders and you want to opt for this particular scheme, then 12 rupees will be deducted. So what is the premium? This is 12 rupees per annum. Do not confuse this with 12 rupees per month, right? Next, in case a member is covered through more than one account, obviously you could be having a savings bank account in HDFC Bank and a saving account in Axis Bank. So there is no so-called thing as double coverage. No, you will be covered just once and anything which has been deducted from you twice will be refunded. Participating banks will deduct the premium amount in same month when auto debit option is given, preferably in May, and remit the amount due to the insurance company in that month itself. So this instruction is given. Suppose your bank deducts the amount of premium in the month of April, suppose, then you have to give the premium to insurance companies in the month of April as well. You cannot just keep having that particular amount for yourself and giving that particular amount to insurance company in June. No, in whatever month you will deduct with auto debit facility, you will remit the amount to insurance company in the same month. You will not keep accumulating the amount with you. Next, the premium will be deducted from the account holder's bank account through auto debit facility in one installment. Obviously, just 12 rupees has to be paid. Let's talk about the revision of premium. So obviously, there was need felt to revise the premium rate. Why? Because the claims were too high. See the claims, the percentage of amount of claims paid to the premium earned, 145% and 221%. That means 100 rupees if premium is being received, then 145 rupees claim is paid. Means premium received is less and the claims paid are more. So in order to remain the scheme viable, this has been decided that what we'll do, we will revise the premium. So now premium has been revised for this Bima Yojana from 12 rupees to 20 rupees and Pradhan Mantri Jeevan Jyoti Bima Yojana from 330 rupees to 436 rupees. And the why this premium has been revised, because claims which are being paid are more than the premium which has been received. Now next is termination of cover. If you have attained the age of 70 years, then your cover will be what you can say terminated. Closure of account with the bank or insufficiency of balance to keep the insurance in force, then also your cover will be terminated, because you are not able to pay just 20 rupees as well. So this cover will be taken away from you. Now next thing is Pradhan Mantri Jeevan Jyoti Bima Yojana. Few of the schemes have been amalgamated under this. First one is Aam Aadmi Bima Yojana. So under this particular thing, this was a life insurance scheme for the poorest of poor who are in the age group of 18 to 59 years. The premium which was being paid under this particular scheme was 200 per annum per member for a cover of 30,000, right? In case of rural landless household, remaining 50% premium was also borne by the state government, and in case other occupational group, the remaining 50% shall be borne by the nodal agency or member of state government union territory. Benefit was 30,000. Now this particular scheme has been subsumed under PM Jeevan Jyoti Bima Yojana. Let's talk about PM Jeevan Jyoti Bima Yojana. So the beneficiary of Aam Aadmi Bima Yojana has been divided into two groups, like 18 to 50 years and 51 to 59 years, right? Total premium is 342, 142 more than the Aam Aadmi Bima Yojana. Second group, 51 to 59 years, is a closed group because these are so close to the maturity. Hence, these has been kept under Aam Aadmi Bima Yojana only. And all those people who are in between the age group of 18 to 50, they have been given under the Pradhan Mantri Jeevan Jyoti Bima Yojana, and their premium is 342 rupees. So all those people who are already very near to the maturity, they will not be covered under PM Jeevan Jyoti Bima Yojana, and they may be enrolled under Swasthya Bima Yojana by payment of additional premium of 12 rupees per annum to the state governments. Now let's talk about the Jeevan Jyoti Bima Yojana. Started in 2015, 1 year coverage, same as PM Swasthya Bima Yojana. Savings account holders between the age of 18 to 50 years. Now see the age which has been covered over here. Wait for a second. See the age over here. The age covered under Pradhan Mantri Suraksha Bima Yojana is 18 to 70 years, right? And the age which has been covered over here is 18 to 50 years. So participating banks will be entitled to join. The person would be eligible to join through just one savings bank account. Cover is for 1 year period, right? This annual renewal shall be from 1st of the June in subsequent years. So this is same. 2 lakh rupees is the cover which will be paid on member's death due to any reason. Remember, in Suraksha Bima Yojana, that was the accidental cover, and if you die on account of the accident, then that 2 lakh rupees will be paid to you. Whereas in this scenario, 2 lakh rupees will be payable even if you die a natural death. Next thing, in case a member is covered under Jeevan Jyoti Bima Yojana with LIC through more than one account, premium is received with the LIC, then insurance cover will be restricted to 2 lakhs. That means no double coverage will be provided to you. Who has administered this particular scheme? So this particular scheme is administered through LIC. Premium, what is the premium? So premium is 330 per annum per member, but now it has been revised. Individuals who exit the scheme at any point may rejoin the scheme in future year by submitting a declaration of good health. Delayed enrollment is possible with payment of pro rata premium. So your scheme starts from 1st June, right? So if you start with June, July, August, then you have to pay full annual premium. If you start a little late, that means from September, October, November, in between this, then you have to pay premium of 258. If you start very late in December, January or February, then another reduced premium. And if you just start at the close of the cycle, that means March, April, May, that means just 3 months are remaining for this period, then the premium that will be payable is just 86 rupees. So premium here is being charged to you according to the time for which you have been covered. So from 1st June 2022, premium has been changed and now 436 rupees will be charged. What is the reason? Because the claims are too much. Claims along with the expenses. When this particular scheme will terminate? When you will attain the age of 55 years. And if you will not maintain the balance into your account for charging the premium, then also this particular scheme will be terminated for you. Next is Pradhan Mantri Vay Vandana Yojana. So what is this Vay Vandana Yojana? I will tell you. So here the person who wants a pension in his old age gives a lump sum money to the government. Suppose he gives 10 lakh rupees to the government. Correct? Now what government will do? Government will give him pension. And obviously at the end of the time period, along with the pension, government will return this particular thing with interest. Right? So now let's just understand this. Minimum entry age, when you can enter in it, 60 years. Maximum entry age, no limit. What is the policy term? For 10 years. Minimum pension that you may receive, 1,000, 3,000, 6,000 per half year or 12,000 per year. Maximum pension is 10,000 per month. So minimum is 1,000, maximum is 10,000 per month. These are the yearly calculations for it. If the pensioner survives during the policy term of 10 years, then whatever pension is at arrear, that will be paid to him. On the death of the pensioner during the policy term, purchase price shall be refunded to the beneficiary, whosoever is the beneficiary. And if pensioner survives to the end of policy term of 10 years, purchase price along with the final pension installment shall be paid. So this is the death benefit. This is the maturity benefit, means on the maturity, whatever the price you have purchased. So I have told you that if you want to be a member in this particular scheme, you have to purchase this by giving a lump sum amount. Then government will pay you pension. So pension is paid at the end of each period. Suppose monthly pension will be paid to you. If you die between the period of 10 years, then whole the purchase price, the 10 lakh rupees which you have given to the government, will be paid back to the beneficiary, whosoever is your beneficiary or nominee. Suppose if you have survived during this period of 10 years, 10 years is the total policy period. If you are alive after this 10 years, then obviously pension has been paid to you during this period of 10 years, and apart from it, whatever purchase price you paid to the government at the starting will be refunded to you. The entity which is responsible for regulating this scheme is LIC. If suppose you have given 10 lakh rupees to the government at the start of this scheme, imagine this. Now you might be needing some of the amount for the requirements. Then government says we can give you loan facility once 3 years has been completed in the policy. Maximum amount of loan which can be given is 75% of the purchase price. That means you can attain a loan of 7,50,000 if you have paid a purchase price of 10 lakhs. The schemes allows premature exit as well. Like if you need the amount for the treatment or critical illness. In this case, 98% of the purchase price will be paid to you. There is no exclusion on count of suicide. If you do the suicide, then also purchase price will be paid to the nominee. Maximum limit is 15 lakh. So what the maximum purchase price you can pay to the government? 15 lakh. Correct? This depends on your wishes. If you pay 10 lakhs, then accordingly you will receive monthly pension. Maximum and minimum pension I have told you, 1000 is minimum pension per month, 10,000 is maximum pension per month. That means yearly maximum pension is 1,20,000. 10,000 multiplied by 12. Yearly minimum pension is 12,000 rupees. That is 1,000 multiplied by 12. Right? Now, what are the provisions for extension of this scheme? Union Cabinet chaired by Prime Minister has given its approval for welfare to enable old age income security for senior citizens. So this has been extended to 31st March 2023. Now few more things that have been changed. The minimum investment has also been revised to 1,56,658 for a pension of 12,000 per annum. So minimum this amount need to be paid by you to the government if you want to receive the minimum pension of 1,000 per month or 12,000 per annum. So minimum, this is the purchase price that you will pay to the government in order to receive this much minimum pension. And this has been revised to 1,62,162 for getting a minimum pension amount of 1,000 per month under the scheme. Next is to allow initially an assured rate of return of 7.40% per annum per thereafter to be reset every year. Annual reset will be made for this rate of interest, just like your rates have been revised for senior citizens savings scheme up to a ceiling of 7.75%. This is the benchmark according to which annual rate of returns can be reset by the government. Who is responsible? So finance minister has the responsibility to see that what is the annual rate of return which is being given to the pensioners, right? So see, you have given a minimum amount to the government. That means you have given a purchase price to the government. Now it is the responsibility of the government, because government is having your lump sum amount. Government is bound to pay you rate of interest. Correct? This rate of interest and along with the purchase price, government is also paying you the pension amount monthly. And apart from it, at the end, you will also get the purchase price. Now, government has capped the expenses to 0.5% per annum of the funds of the scheme for first year, and for rest of the years you cannot spend more than 0.3%. That means the fund which is being managed by LIC cannot spend more than this percentage on the fund management. So this is it. We are going to cover only this much in this particular lecture. Wait for the next lecture, and I hope that you have learned something out of this lecture. If you have loved the video, then please do not forget to like this video. Thank you so much.